So we're above all-time highs on the daily chart, so that's kind of all you need to know. You can see every down close candle we're creating on the run higher is supporting price higher, which is characteristics of a low resistance move. See, we trade down into this down close candle, which is a bullish order block, trade higher. So continue expecting the same until we create a short-term high for a retracement into a range. 4 hour, there's not too much for me to look at. I would have the new day opening gap on there. The sell side is intact and we have a new day opening gap beneath here. However, like we're at all-time highs, I'm not looking for sell side to be a draw. Like I said yesterday, I'm not looking for sell side. Like if we just recap yesterday a bit. In here, I said I'm not really looking for sell side. Can we trade down into these lows and go higher? Yes. I said I didn't want to see this low taken. We took it, and then we got the delivery to the high. So we just took sell stops and then ran into buy side. Obviously, I was off the charts at that point, but we got that. Looking at it today, we're trading down into this bullish fair value gap. So on the hourly, trading into that bullish fair value gap. So just mark that out. Trading into short-term sell side under these lows in there, and then you can see the body's failing to close under. So then I would just anticipate all-time highs to be traded to again. If we do start showing bearish order flow, and for example, depending on how we close on this wick, so for example, this hourly candle, this 8 AM hourly candle, if we close above this wick, that should act as a balanced price range to continue going higher. If we fail to close above that wick, then it could be used as a premium array to attack sell side under pre-market lows. But we're all-time highs, expect all-time highs to be traded to. Yeah, there's the 4 hour I'm not really too bothered about. There's not much. I would just use the hourly. So dropping down onto the 15 minute, you can see how we drop into sell side under here and that inefficiency. And now you want to kind of see if we get a market maker buy model side of the curve here, where every down close candle will support price higher once we close above. If we close under, so if we close above this down close candle and then close under it, that should be used as a breaker. Or if we close beneath this low now, then we can attack sell side in here and potentially into this range a little. Other than that, there's not too much. Let me count that. We got relatively equal highs here. We purged this high there. So we have buy side all through that range. If we do start breaking down and closing under old lows and closing beneath discount arrays, then these relatively equal lows here may be a target. So again, I favour all-time highs and favour a continued run higher. But if order flow shifts to a bearish stance where premium PD arrays are being respected by price and we're continuing to deliver something, for example, like this, right? And order flow switch to a bearish idea, then I can use that low as a draw, but that's just not what I'm favouring. I kind of need to wait till open. And then you can see them relatively equal lows down there on Nasdaq. If I quickly, just before market open, mark out the new day opening gap. What am I doing? So we trade into a short-term discount and then purge into that buy side here. So I would want to see how we react to a high of a new day opening gap towards 9:30. If I keep on a 5 minute maybe, if I mark out the gap on that. So this is the settlement price from, so I can mark it as RTH gap low because we're going to open above it. And then it's going to be around there. We're going to open up. So we're opening above buy side on RTH chart. So RTH chart. So we're opening at all-time highs on the regular trading hours. So again, favouring just buy side delivery. And if it runs continuously above at 9:30, it's just I'm not in a move in it. That's fine. I am not going to be taking any trades today in general, mainly just because it's a Friday and I've had 3 pretty good days this week. So I'm not risking giving back profits. Let's just put this on. I don't know what's that. I'll do it like that. So we trade into that fair value gap, staying in the upper portion of it, still continuing bullish order flow. So in there we take the buy side, return to a short-term discount here, and then deliver above this short-term high. So that's a fractal market maker's buy model with sell side curve to buy side curve. So there's 9:30. We've got the opening range gap here. So if we're really bullish on the day, we won't fill this entire gap. We'll stay in the upper half of it and just continuously deliver him. I personally want to see a run lower in here, only because this is way too clean for me to leave. But we'll see how it delivers, because we got all-time highs up here. So on a 5 minute, look at this delivery in here. So you can see the delivery of these candles. If we're bullish on the day, there's no reason for us to come lower. You see how this candle that created this buy side balance, sell side efficiency in here, that was the only fair value gap since it's this low. Since then, we've had a lot of wicks. So we've had wick, 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 wick back through that range, wick through that range, right? So all of this becomes a balanced price range. And then you can see the delivery to all-time highs from that 1 minute fair value gap. And then now we're above all-time highs. So when you're above all-time highs, what do you do? Well, you kind of want to do standard divs off. For example, let me set up this quick. Minus. So you just want to do measurements from previous legs. I'll just monitor order flow above there. So you can see we get above the new day opening gap. 9:30 open, we trade lower, failing to get deeper into the RTH gap, which shows strength. Trading into this fair value gap, and then, for example, in here, once we're monitoring bullish order flow on a 1 minute chart, then you can go on lower time frames and see the price delivery from it. So, for example, this is like a textbook example of my model and what I look for in terms of a new low to perform in here, and then see how the delivery from that low presents itself. So you can see as soon as that low forms, every fair value gap that's being created is either being partially left open or leaving as a breakaway gap. Every down close candle that gets closed above is supporting price higher, so on, right? So you can see as soon as we create that low in that 1 minute fair value gap, in this lower time frame fair value gap as well, we create the change in state of delivery, as most people call it, but that is also a breaker block where you have a high, low, higher, high, and then we return into it. It's just a balanced price range. So you can see that in here, down close candle, we close above it, trade back down into it, paired with fair value gap. So you can see fair value gap here, bodies staying outside of it. You can see a little fair value gap here, which I'm going to mark out just for reading that run, and then we leave this as a breakaway gap. Most of your breakaway gaps are going to form when we're in a low resistance run inside of this, within this range of, for example, the breaker or the manipulation. They're all going to form within there because we've had, let's mark it. So let's mark red as sell side delivery. So we've had sell side delivery through that range, right? So we've had sell side delivery through that range. I know it's a bit small. We've had buy side delivery here. Let me just, once I get it, let me just do it black because I can't see. So a buy side delivery through that range there, through this high or this low to this high. That's a stage of buy side delivery. Then we create that high. We offer sell side delivery. So that is creating that new low under sell side, right? Then once we create that low, we offer buy side delivery. So at that point, this has been efficiently delivered where we've had sell side delivery and buy side delivery, right? Between this high and here, there is no sell side delivery, right? Because all we've done is offer buy side delivery through that range. So the market, what the market will want to do is offer sell side delivery through that range in the form of that price run, right? From that high to that low. I know it's looks awful because we offer sell side delivery through that range, and then once we're going higher, we offer buy side delivery. So your breakaway gap is going to form within this range of previously balanced price. So between this high and this low, where price has been delivered both buy side and sell side, and then we traded outside of that range, that's where your breakaway gap's going to form because it's a breakaway gap. You're breaking outside of the range, right? And then you can see that where you have, let's just go on a lower time frame for a sec. Let me just copy both of them because I just want to annotate that. So for example here, right, you have original buy side delivery where price is offered higher. Then you get sell side delivery through that range. So that's offering lower prices. So you can see from that high to that low, it's offering lower. And then you can see through this range, from that low to that high, right? Or even through this range, through there, that's offering buy side delivery, right? And then that could be fractalized to whatever measure where you can use the bodies where that's buy side delivery, sell side delivery, buy side delivery, sell side delivery, buy side delivery, so on, so on, so on. But you can see how once we offer them prices, you see when we close above that range where that previous balanced price delivery is, notice how we exactly return into the high and then continue higher. That's your breaker. That's your balanced price range, right? And you'll see that so often where we don't trade beneath the old high. And that's where support and resistance works because it's how the market delivers. But you need the, I guess, understanding where price is going to go. And I get this is on a seconds time frame, but it's just the easiest way I can demonstrate. that in that price run. 8 o'clock. What here? What are you talking about? This accumulation coming back down into that, or this formation here? The last one. Okay, we're off to the moon. Okay, we'll just do teaching. Yeah, I am recording. Well, I guess we can just I guess I can just answer questions because I'm not trading today, and we are now at all-time highs. Like, notice the delivery here from this 5-minute chart, right? If we're bullish, we're not going to reach consequent encroachment and trade beneath it, because that is the biggest characteristic of higher prices. And then you can see where we come into here. So notice on a 15-minute, the balanced price range, which we're talking about, and that's linking down onto the 1 second, which I was just talking about, but it's the same principle here, right? At the start of the stream, I said, if we close above this down close candle, I want to see it used as a bullish order block to continue price higher. And if we close beneath it, it should be a breaker block, right? To deliver sell side. Notice how we exactly, like, I'll thin that line out, return back into the high of it, because that is the last sell side delivery. So we're returning back down into it to offer that price, and then we expand higher. So it's the same concept there, right? And then you can just see this whole delivery where the opposing candle is supporting price. You can, but like, I'm entering on like a 5 second usually, so like I just mark it in. But this is the whole idea or concept. Hardy, could you please explain? 1 second, I'm going to take a screenshot because if I'm recording, it's easier then to know what question I'm answering. Could you please explain how to use order blocks correctly? Do you limit or look for momentum away, then market order? What time frame OB do you give priority to? Also, is OB supply and demand in a way? I haven't really studied supply and demand, so I can't comment on that bit. There may be similarities, but in terms of order blocks, look at the price runs, right? When we create this short-term high, you see how we failed to close over this high. So that's the first sign of a potential reversal, right? Then just study every single down close candle or up close candle when we close beneath it. Sorry. So look, here, series of up close candles, we close under it, we return into it. You could do the same here, but this is internal of this, so I would use these. So I would use these ones, but that's internal structure of using order blocks. Okay, close under there, return back into it, close under there, return back into it, trade lower. In here, up close candles, close under it, trade back into it, trade lower. Up close candle, trade under it, trade into it, expand lower. Same here, close under it, return up into it, trade lower into that sell side. Then you can see here, we close over a down close candle. So at that point, to me, that is a sign of a more high resistance condition or more non-expansion move we're going into. So that can lead to a retracement or a reversal, right? Or high resistance conditions. And then we can see we have one drive lower into that sell side, and then we trade away from there. And then once this low's formed, I'm monitoring order flow or monitoring what side of delivery are we favouring, like keeping balanced, right? So in here, we create down close candles while attacking that low again, fail to get under that low, and then we close above them here. Then I monitor this inefficiency. Then order flow is currently bullish until proven otherwise, which I always say. Like, I'm always bullish until proven otherwise. Like today, I was bullish until I was proven otherwise by a closure under any of these lows. So again, here we get a down close candle, we get a fair value gap. What did I mention when we have a range like this, right? When we have a range like this, we close above it. That is likely to be a breakaway gap. And then we trade higher. Why is this not a breakaway gap? Because you can see where it's formed. It's formed at this old high. So we still need to balance into that high to deliver that efficient price delivery. So that's why we return back into it, whereas we don't with this. But looking for entries off order blocks, for example, on here, if I'm looking for an entry, let's not do it on that one, because let's do it, for example, off here, right? Once we close under here, this red line. And then I had a draw of that low was already traded, so I don't know. Let's just read price delivery for now. So let me replay to that. So that's your 50-minute opposing candle we closed under. You see how we're still closing under lows here. We're not bullish. Yeah. So any retracements will be into up close candles on a certain time frame, and I'll get into that in a minute, how I use all time frames. But then I would go on to a lower time frame, and this is where the price delivery. Actually, I'm gonna do that on. Sorry, I'm just gonna let me do it on a blank chart because it's easier. So then you go down onto a 5-minute, right? Then I'm seeing what we're doing. We're wicking up higher. You can see the candle body closing. we're not showing strength in here. That is showing a lot of weakness, but the wicks are doing the damage trading into this old balanced price range. So then I'm monitoring, going down the time frames to look for potential entries. Well, this technically could be your confirmation of opposing candles, where we close under it here, return into it, but like following Dodgy's model, you would be break even if you're break even and at this low. So that's why I'm kind of going on to lower time frames. And I don't know if this example gives a great thing, but we trade up into that premium here, taking the measure of buy stops. I need this high as well, you can include. We then trade lower, creating 2 fair value gaps. On a lower time frame, this range here is going to be balanced. So you can see how we have an accumulation, run higher, and then back beneath that accumulation. So that is your like breaker, where you have a balanced price range. So that's where we're returning up into there. And then on a 1 minute, that leads to this fair value gap. So we've got this fair value gap, we're staying under midpoint of it, you could include the volume balance, and we're leaving this as a breakaway. Then up close candles, volume balance, trading lower. Up close candles, close under, trading lower. Up close candle, closed under, trading lower. Here, up close candle, I'm going to mark out the whole range just because. Here, we're not closing above it, trading lower. Up close candle, trade it, closed under it, trade up into it, expand lower. Then here, you can see, this is the last up close candle which got closed under. These didn't get closed under yet. Gets closed under there, return up into it, expand to sell side. Then you are monitoring at all of these lows. Are we closing under them? Here, do we close under the low? No. So I'm going to look at price delivery. For a sign of a continuation lower, I would want up close candles to support the price lower. What do we do? Close above. So that's the first sign of a potential reversal or retracement into this range, and that's where I cut loose, right? And that can be fractalized onto a lower time frame. Like in there, I'll be on like a 5 second or 15 second, and once we start closing above previous ranges like this, I know it's pre-market, so it's a bit more worse to see. But when we're closing above previous ranges and respecting bullish PD arrays, I would just cut my trade, like cut the trades early before like it goes into unnecessary drawdown, and then just look for a re-entry in here using the exact same model. So for example, once we would trade up into a higher time frame PD array, here, you've got the original here, which wouldn't give you an entry. Here, you would get an entry, but you would suffer drawdown. And where would your stop be on this entry? You have to use the price delivery continuum, and it would be within a breakaway gap on a, so it's not a breakaway gap on a 1 minute, but it's a 2 minute. Isn't it 1 minute institutional order for entry drill where we're leaving it up, the upper portion open? That is showing weakness. And what was that on 30 seconds? And then you can see here we're just trading into this inefficiency. Are the bodies staying out of the upper half? Yes. Displaced lower. Then, up close candles. Close under, return into them. Bodies failing to close high. Come lower. Here, up close candle. Close under it. Use that as support. Or we close at it, sorry. We open under it. Then, close under this up close candle. Trade up into it there. Or here first. And don't close above it here. This is a little retracement I wouldn't be a big fan of. Then we close under these up close candles in close proximity to this sell side, fair value gap, and then we trade lower, right? And then once we do this, where we create close under an up close candle, and then we create these down close candles, closing under it. Once we close above and down close candles, that's technically a change in state of delivery by definition. But you have to use all time frames in alignment, and that's why on one screen I've got this chart basically at all time. Well, so okay, I'll just do it quickly. The focus tab is just my main asset. So it's just NASDAQ. It just has 2 or 3 tabs normally, and all of them linked together. Indices is just a blank chart of all 3 assets in a tri layout, so 3 layout. This messy chart there, these are all, there's no sync at all in them, because there's no need to have a sync in them, because it would just make every other chart messy. So if I want this on, for example, if I want to put, let me do this. If I want to put this on my main monitor, just to show, I would just do this, right? And that's gone, great. And then you can see that shows on my main monitor, and then if I go out of replay, you can see how bodies are respecting midpoint there, close above it, trade down into it, expand higher. And my main focus on here is going to be the 15 hourly, 15 minute, 5 minute, 3 minute, 1 minute. and then entries will be seconds, but normally I try and stay off that as much as possible. Which time frame would you give priority? So giving priority, I'm literally just looking at this, and you can see opposing candles. For example, it was yesterday where we start showing bearish order flow, right? I'm monitoring ranges on all of the time frames, because all the different time frames is just different time periods of the same range or price. They're just different time intervals of opening and closing. That's all it is. It's still showing the same range or price. The price axis is the same. It's just how the candles are scrunched together, which is different. So for example, here I'd watch this 3 minute down close candle. 2 minute we didn't close above all of them, but I would watch the first one there. On 1 minute we closed above this range, so ideally if bullish you would want to see this range support price higher. If we get beneath it, it could be used as a bearish order block to lower targets or internal lower targets, and then I would just keep scaling down. Mitigation blocks is the exact same as I mentioned earlier in terms of it's just balanced price ranges. Like, think of that explanation earlier in terms of what I said about breakers, where that is a balanced price range, right? It's the exact same in delivery of a mitigation block. So a mitigation block is just this, right? It's the exact same where we've had sell side delivery, buy side delivery, sell side delivery, and buy side delivery. So if we're really bullish, we're not going to return above that old high. It's just a point of mitigation. So the layout of my monitors on this chart, this main screen you can see is my main monitor, which has all of these, which are on other tabs. Then on my right hand side, I have, let me just get it over, this, which has ES, which is the same layout as I have on the main monitor. And then I flick between these, so the indices up there, or execution, which is just my execution panel, and the messy chart, I call it. But that just shows the regular trading hours gaps, new day opening gaps, and these are the daily PD arrays, what they looks like on the daily chart, and then this is just it put down onto the 1 minute. And then on my other monitor, I've just got ES on there, on this layout, so hourly, 1 minute. And then down on my bottom other monitor is just Discord. What's the difference between mitigation blocks and breaker blocks? It's just one, so a breaker block, so let me make actual diagram. So a breaker block is, so a bullish breaker block is where we create a low, high, lower low, higher high, and then that range there is the breaker. Whereas a mitigation block is a low, high, higher low, higher high, and then that's where you look for the entry. So if you want to take a screenshot of that, you can. So you can see that run higher. We've responded out of 3 minute down close candles. When bullish, every down close candle is going to support price higher, and you can see a rally off that. Based on an entry on that, you can technically go on to, so for example, with 3 minute down close candles, if that was gauging price on, then I would put that line onto lower time frames. For example, 45 second, they were the last down close candles, so you can do it there. 30 second, that was the last down close candle which got traded above. In there, same thing on the 15 second, and then you got paired with an inefficiency, so you can look for an entry within that. And then you can see just before us taking this high, we returned down into the range, last down close candle. Fair value gap, we do colour outside the lines a little bit, but order flow is still bullish. Close above this down close candle, that's an early change in state, which I kind of always say. And then we obviously trade higher, but that is that's just a very quick expansion of it. But that's kind of how I'm using all the time frames in alignment, and then you can get that run on a lower time frame. What are the indications of that is potential retracement or reversal? When we continue to stop, so 1 second, let me just, how do I want to do it? Let's do this. So we'll just write it because it's easier visually. I'll look in 1 second. So this also comes in line with signs of reversal or retracement or consolidation, but it's all using, we'll get a picture, this, and you've probably seen this before, but they're the stage of price delivery, and what I try and capture is the expansion phase when price is in expansion. That's the only reason my model works, really, or just any model works, is in the expansion phase, is that's what you're trying to catch, because you can catch the reversal phase, but you want, after reversal, you want it to go into an expansion. So failure to close under / above old highs. So failure to close under old highs and lows, so that is basically of the existing range. You want to see, for example, for continuations, you want to see expansion consistently above old highs, so that means closing above old highs, so you can see in here, so you can just see on the right hand side of my chart. You want to see us close above old highs and then continuously, right there, close into it. That's a balanced price range, that's a balanced price range, close above it, return back into it, expand, right? And now, for example, there we close above it. That's 6 signs of a continuation, whereas a reversal would come along the lines of try and find a good example, kind of like this on a 5 minute, right, where you have a failure to close. That's the first sign of a retracement or reversal, and then you would monitor the next candle after that high is formed. Does it fail to get to 50%? Because if that wick is formed like that, if you are bullish still, you want to see us get above that wick quickly and you use it as support. Whereas if you are potentially in a quite high of a premium and looking for a short-term reversal, you want to see it stay in the lower portion and then deliver bearish order flow, and then you can get your model away from that. I know this is let's lower the size. Opposing PD arrays supporting price. So if you are having a lower price movement, for example here, if you are having a higher price movement and then we create an inversion like this, if we are failing to get back into it and we are respecting it in terms of its characteristics as an inversion fair value gap, that is the first sign that we're not likely to go higher, because you want to see any... is it anyone else got problems with hearing sound? Only because I know there's a pretty big issue in this channel at the moment. Okay, well, so you can see how we close under it and then bodies are failing to get back into it and then we're delivering order flow. That is a potential sign of a retracement or reversal in terms of it's not a continuation. You have breakers / mitigation blocks. That is a smart money reversal of a market maker model. Higher time frame draws have been met. It's just anything which is the opposite of a low resistance condition, basically. But it's the best way to look at it for me is identify what characteristics of an expansion looks like, and then if it isn't showing them characteristics of expansion, it's doing one of the other things, which is retracement, consolidation, or reversal. What goes out of the window at all-time highs? Like what goes out of the window at all-time highs? Can you do the whole reversal thing? Well, it's not that the whole reversal thing, because the reversals can happen on a 5-second chart, right? You can still catch reversals of certain, I guess, moves, but you want to always look for higher prices. So the reversal should be into a logical discount array which isn't outside of the current dealing range. So for example, if we create a 5-minute fair value gap like this, right, you can look for a reversal up here on a lower time frame to trade down into that, but you're not trying to catch the whole move down into these lows. Like, you have reasonable expectations. If someone's starting 50k either for the first time, what kind of risk management would you recommend? Sticking 1 to 2? Yeah, I would recommend that, and having restrictions on your account. So for example, like have a max daily loss limit, have a like lockout when you take 2 trades, you lock out, or have that as a rule on, like, because I know you can do that on like Tom's to Pegs. It's not that you don't short at all-time highs, but rather don't reach for maximum target. Yeah, you don't reach for maximum like sell-side targets if you're looking at all-time highs, right? And people will be like, oh, you can't short at all-time highs, you can't short at all-time highs. Dodgy takes a short at all-time highs. Why did you short at all-time highs? Don't short at all-time highs. Well, all-time highs you told us not to short. That doesn't mean you can't find short setups. It just means that you have to have go for the low-hanging fruit targets of it. Like, so many people will listen to, for example, Dodgy saying don't short at all-time highs. If you're not shorting at all-time highs, you're only going to look for longs at all-time highs. And believe it or not, most of your trading will be at all-time highs. Most of your trading will be at all-time highs. So get used to it. That's the reality of it. And some people that I know haven't experienced trading at all-time highs at all, because we haven't been at it in a while, like since October last year. But like, look overall, like even since I started, so around here, right, all of these periods here, I technically trading at all-time highs here, all of this, right? You're going to be trading at all-time highs a lot of the time. No, I don't. Because in terms of power of 3 is fractal. It's not based on, like, you would say, right, we didn't get, for example, here at 9:30. You may say, oh, you couldn't see a setup at 9:30, but like here, you've got accumulation, manipulation, distribution. Like, it's all fractal. And you just need to know what you're looking for, like your draw. It's not that it's less likely. You're less likely to get like a massive accumulation, and then we trade lower into a higher time frame, like daily gap, and then get the distribution away from it. It will still happen, but because we're in a continuous expansion profile, maybe a bit less likely. So we disregard looking for 50% of range. Like any continuation setup would be considered an A plus. I don't know. I'm not going to answer that because I don't think model setups are A plus. I think every setup is following your model, and it's not the setup which is A plus, it's the conditions you're trading in. Like any setup can be A plus. Like my A plus setup will be different to Dodge's A plus setup, for example. But you can see, like, if people are trying to catch shorts at any of these consolidations, they're just likely to get wrecked, right? On a 1 minute chart. Like, focus on just watching price, especially if you're uncomfortable. Just get some experience looking at price at all-time highs. Yes. Because technically, the best, like, for example, the best longs, so if this is the range, like, if this is a dealing range, right? We took a high time frame PDRA and we traded into a new range. That is your dealing range, right? And just say we got a little smart money reversal here on a lower time frame, right? And that's your smart money reversal. You don't want to see the market trade into 50% of that range. Like I was mentioning earlier with balanced price ranges, the best longs, the most expansive longs will happen in a premium of a range. So, for example, in this range here, the best longs, the longs which you'll get in and will run instantly, will happen in that area of the range, because it's showing underlying strength. It's showing there's no need to come down into a discount. It's showing that maybe that discount has already been balanced like this. So, for example, within that range, right, that is the old high, and like I was mentioning earlier with balanced price ranges, there's no reason to come down into it, so you're likely to see something like this, where we trade into it, and then we get a quick reaction out of it, and for example like that, right? And then that would be like the dealing range low, that would be the dealing range high, and then at that point it becomes, for example here, you have a dealing range low, dealing range high, and like that's an implied dealing range, so that's a dealing range we've already used. Let me just change the colour of that. So for example there, the best longs will occur in the upper portion of that, because this, you can presume, is all balanced. So you wouldn't want us to trade down into the lower portion of it. Let's look at YM. So YM's had an attempt to go lower, create relative equal highs, and then started expanding. There's not much I would have participated in there. See what gold is doing. So gold has traded down into this daily, which I say is it's a daily bullish order block. So this red line is a daily bullish order block. We are in this daily SIBI, but I would monitor at both levels. So what I would have on one of my charts is this, for example. And then you monitor how we trade into that high time frame level. So we trade down into it overnight, trade into this inefficiencies of this leg coming into this range. Then in here you can monitor this delivery. So 8 o'clock high, we trade into it. Do we close above it? No. So that could lead to a retracement. Where can we retrace into? Well, we have a 5 minute fair value gap there, right? I keep going through time frames, but there's all of this inefficiency that's we've created going higher. Then we're leaving breakaway gaps. The lowest I would want this market to go in here and the retracement is this old high. Why? Because that's a balanced price range. So we failed to get to there, which is showing strength, leaving this as a breakaway gap. Then create a low, trade higher, down close candles. On a time frame, that's going to be a balanced price range. So, or it's going to be an order block on like a 2 minute, for example. You see them 2 minute series of candles, that's a 2 minute order block. It's just ranges of price. Close above it, return into it, leaving a little breakaway gap. Trading higher into the lower quadrant of the daily fair value gap. Short-term discount into this fair value gap, expand higher to the next level. The consequent encroachment of the daily fair value gap. Short-term discount, fair value gap. You have to include volume imbalances. Then we close above the consequent encroachment. We then open, tap it, expand to the upper quadrant. Now you would see how we respond in this fair value gap for a continued delivery while we're in a low resistance run. I don't really trade gold, but that looks interesting. And then you can see this whole range. Where does this breakaway gap form? Within the range of a balanced price range. I'm gonna give me a sec. Let me try and find something. Give me 1 sec. Okay, put the audio on this stream. I'm gonna be quiet for 2 minutes and just listen to this. This is the best. Actually, should I just get it up? So let me download it. I'll just get it up. Like, this is the best explanation of what I'm looking for expansions, and it's from ICT. There you go. Okay, I'm just going to let this play for a minute. Just listen. But that literally defines different price runs. And I know most people, like, don't listen to ICT. Most people, like, for example, like, 10 people left while that was playing, right? And, like, people don't want to listen to ICT because he talks a lot. But I wouldn't have any understanding I would have now without listening to him. Like you were saying, you want to see every single down closed candle when bullish to repel price higher. I studied that. When he said that, I went into price, looked at other examples, and then came up with the idea of the balanced price ranges, and it all just links up in a chain. So I would obviously recommend watching ICT. Like, I'm not going to not recommend watching him because I've watched so much of him over time. But if you want the easy way and not understand delivery and just want an entry model, go watch other people. I'll go through I'll quickly go through which ones I would watch. So this is ICT's channel. Go to his playlists. I would start with 2016 core content month 1, 2, 3 and 4 because that gets up to the PD arrays. Then forget the rest. Then go on to the end series. Then the if I could go back and tell myself what I know now. They're both more psychological. They're only 4 videos each. And then go 2022, 2023, 2024, 2025, 2026. No problem. I would be looking for continuous run higher and supporting previous ranges. Like, there's no indication of any bearish order flow. Like, price needs to have a willingness to go. If you want to look for a retracement, you need to see structure present itself to go lower. And right now, the market is an expansion. Look at the 15-minute chart. There's no way anyone would short into that. I'm sorry, if you're shorting into that at all-time highs, just wait. There's going to be another trading day. Like, you need some structure to, I guess, be present. And yes, we're slowing down up here, so potentially a retracement into this range will happen, but it's whether you want to take some unnecessary loss for no reason, trying to get into a trade for the reason of I want to be in a trade, right? Like, we're so far into a premium right now of the market. We're at the highest, like, right now, within the last 15 minutes, we have been at the highest point this market has ever been in, right? So there's no point calling a top. Like, because we're at that point doesn't mean it's going to slow down. Like, if you're trying to sell, like, every time the market is creating all-time highs, for example, in here, right, you would get absolutely fried. So to me, I would just wait. What you would want is to see something like this potentially come down into a measure of sell side into a higher time frame PD array, and then start delivering bullish order flow, and then look to participate in that price run, right? And if it doesn't offer you that, then you don't have to. So it'd be just me going looking for higher prices until proven otherwise. I'm not going to be annoying, but did you take these buys? Because probably you. But I don't see an execution there. I'm not gonna be annoying, but, like, I don't know if you took them, but I didn't take them. I would never trade into market open like that, like, because what you're doing, okay, in a case like this, it works, right? But if it was to fail, you'd be like, oh, it was just because it was market open. I shouldn't have even took that, right? But then you brag when it plays out. That's the thing I'm not a big fan of. Did he? Yeah. And it's not a bad trade. It is probably an A+ mechanically, but in terms of we're at all-time highs, or not at all-time highs, we're coming into 930. Like, it's just, like, what if we got a little wick lower there, right? I know it's all what ifs, but, well, pre-market, yes, but not 1 minute before market open. I know it wasn't 1 minute before market open. Well, as long as you're out for 930 volatility, you're good. No, I'm going to head off in a minute. If anyone's got questions, let me know. I said I wasn't going to be on too long today, but it's already nearly 10:30. So, and all of this, like, if you want to go back, it'll be on, I don't care saying this, to be honest. It's on my YouTube, and you can find it by connections on Discord. Yeah, cool. For standard divs, just use previous ranges. So, for example, just use, like, daily ranges, for example, like the just projections of everything, right? You can add other projections, but just do it between different ranges. So this high, this between these. between all of these retracements. You're just trying to get logical levels. But how I normally do it now is until we close beneath a PD array. All time highs. Some money for some time. I try to see I love risk rewards in this system. And well, it's not directly that. Like, it's risk to reward in support and resistance is exactly the same as ICT. It doesn't change, and you have to commit to ICT. Like, you have to commit a lot. If you actually want to learn ICT, you can obviously use Dodgy's model and other people's models, but you're getting basically second-hand teaching, which I'm not a big fan of. Okay. If I've already answered you can go back and watch it. Yeah. Yeah. Okay. Yes. Yep. Can I I don't want to be annoying. But if you want an in-depth thing of that, go back to this video after when it's uploaded. Yeah, I was on the 1 second and explaining, like, I went pretty in-depth in it. But yeah, you're right in all of that you're saying. Look at a 15-minute chart and how we trade into that. Oh, we didn't even trade, don't worry. On MNQ. Go on to MNQ, quick. Look at that 15-minute candle, the high, the down close. Yeah. But yeah, obviously I'm on MNQ. But yeah, I would recommend going back to that video because I actually kind of explained it very in depth and I don't really want to repeat it again. Okay, but if you got any questions, just message me later. I'll send you the timestamp when it is. Yes. Yep. Okay, I'm gonna get off because I have to go do some stuff. But I'm gonna. If anyone's got any questions, just DM me. Well, I watched it while the 2023 mentorship was going on, so 2023 it took me. But I started trading in 2023 March, and I was basically watching it the whole way through as he was posting. So I just had to do a little bit of catching up. I personally don't trade Dodgy's model now. It's a very good model. You need to know draw on liquidity as well, though. Yep. So here, yeah, for example. Well, okay. So what I'll be looking for is just how we react out of this fair value gap. I'm monitoring order flow when we're trading into it. On lower time frames, once we're trading into it, do we show bullish order flow or do we show bearish order flow? And that all I'm saying with bullish and bearish order flow, for bullish order flow, I'm looking for discount arrays to be respected while premium arrays are getting closed above, vice versa, right? That's kind of all I'm looking for. And then if we start like closing under these ranges, it's just bearish until proven otherwise. And if I'm getting in a short up here, I would just keep trailing my stop. And if I get stopped out on the trail, it's most likely we're going to retrace into that range. Here's pretty safe. That's pretty safe. Look, I'll show. So 50% of that wick, we failed to close above. We then start showing bearish price action. In here, it doesn't look that ideal on a 1 minute chart. So then I wait for example, this candle to close here. So wait for that candle to close, which the next one opens, and then I'm going down onto a lower time frame for a potential PD array. Okay, we got a down close candle. Here, we close out the low of it, return up into it, and start expanding lower. That's basically what I'm doing, and then that's with all the range above is balanced. So you see this wick balancing that price delivery. So we're closing under this low, and that becomes a balanced price range. So once we create that close candle and close outside of that range, that should support price lower, and that technically gives me a stop above that high on the candle closing basis, and then I can kind of trail my stop accordingly. Fair, right? Okay, I'm gonna head off. Have a good rest of your day, guys. I don't know if anyone wants to stream in here because there's quite a lot of people. If anyone's got any questions, just DM me and I'll answer. Goodbye.